Hello, everyone, and welcome to today's webinar. I'm Niranjan Avasthi, and I'm delighted to have our CIO Equities, Mr. Trideep Bhattacharya, joining us today. Over the past 3 years, mid and small cap stocks have demonstrated remarkable growth, boasting a CAGR of 30%, which is twice that of Nifty 50. Moreover, in 3 out of 4 calendar years post-COVID, mid and small cap stocks have surpassed large cap in terms of performance. So what's next for small cap is the burning question in many of our investors and our own minds. So today we aim to delve more detailed into this and many other questions, and to share insights on this, we have Trideep, who will guide us through this dynamic market environment on mid and small cap today. So Trideep, welcome again.
Thank you very much, Niranjan, and thanks for organizing this. I think this is quite a pertinent topic. Time for the times, actually.
Absolutely, I think so. In last 1 or 2 weeks, all WhatsApp groups, at least in the financial markets, is buzzing around small and mid caps for obvious reasons. So we thought, let's interact with our partners, listen what feedback they have, and answer as many questions we can to help our investors ultimately. So Trideep, to start with, before we get into the nuts and bolts of the matter, let me ask you a very basic question. Why mid and small caps outperform large caps in the long run? Or this is even correct expectation to have in first place, that mid and small cap should always outperform large caps predominantly over the long term?
Well, yeah, I think it's a great question to start with, Niranjan. And I must admit, when I was looking at data, which is more than 10 years, so, small, large, mid and small, this whole definition actually came by somewhere around mid 2005 or thereabouts. And when I was looking at the data over that long a time frame, what I found is that the growth of mid and small caps are a couple of percentage higher than large caps on a CAGR basis of that over that period of time, which is more than 10-15 years. But that is just saying that would be injustice to the overall trend. Once we look at this data with a little more sort of nuanced view and with a bit of a microscope, what I find is that during cyclically good times, mid and small cap growth actually gets amplified as opposed to that of large cap. During bad times, it basically reverberates on the negative side even bigger. So the beta to the growth rates, particularly in good times, is high on the positive side, and likewise high on the negative side when times are bad. And hence what tends to happen is when broad-based stability in markets are observed, when earnings resilience is observed like we have been seeing over the last couple of years, the earnings growth of mid and small cap tends to be on the higher side as compared to that of large cap. And of course, growth investors, to chase the same, move towards the same. So to answer your question, in bull markets, you will find that mid and small caps outperform the large caps for a reason, because during those times, fundamentally, economic point of view, the growth rates of mid and small cap are actually higher than what you see in large cap. But it just comes with the caveat that when times turn negative, the growth there delta is equally high on the negative. So you've got to be careful, and hence I think choosing the right fund becomes important to manage the upcycle and the down cycle carefully.
Great. So it would be safe enough to say that mid and small cap as a segment are higher in leverage on a higher basis compared to large caps to the economic growth, right?
That's true.
Got it. There's another belief that small and mid caps are very small businesses in size, and also another, I would say, rather myth that they are usually on a lower quality, segment, or the quality is, slightly lower than large cap. So is this a myth, or, can you share some example? What are your thoughts on this?
This is complete bunkum, I must say. I mean, while there would be a segment of small caps which will be smaller in size, but it is not that the top 3 players of the industry are large cap and the smallest 3 players are the small caps. The reason I say so is, I mean, enough number of sectors. If you look at it, for instance, we were speaking to a turbine manufacturers. The company with a 50% market share in turbine manufacturer is basically a small cap. Likewise, when we were analyzing the consumer sector, a 100-year-old brand in pain relief management is a small cap today. Likewise, a 75-year-old personal care brand is basically a small cap. So, and I could go on and on. The last one I would tell you is that the largest explosive maker in the country is a mid-cap. So likewise, and not so long ago, basically the largest government defense manufacturer was also a mid-cap. And finally, the leading genset, the largest generation set maker in India is still a mid-cap. So, I mean, I think with a lower threshold of mid-cap being close to 21,000 crores, and the definition of large, mid, and small being done on a ranking basis, what that means is that some of that even the smaller companies, what we call traditionally now as the small caps, in the context of the business that they're into, are leaders in the segment that they're in, and hence are very much investable, and not only investable, can be very profitable from an investment standpoint over a period of time. The other perspective that I would like to add here, Niranjan, is mid and small caps are companies that should be thought about as companies which are going through a bit of a metamorphosis. By that I mean that the ideal company in our portfolio, and the ideal portfolio, of course, you may not like it when I say this, is a company that starts as small cap, grows to become a mid cap, and ultimately goes on to become a large cap. This transition is basically what creates wealth for investors who have a long-term horizon. And the best place to start is basically, in that case, a small cap, where overall, over a period of time, you play this transition very well. So on the whole, I would say that the mid and small caps is a fairly heterogeneous bunch, can't be thought about as a one monolith, but should be thought about as companies as undergoing metamorphosis. In sectors which are niche, you also find industry leaders and companies with very good corporate governance worth investing in these areas. And hence, the name mid and small cap could also be thought about as emerging leaders, or in that context, a specialized market players, rather than just categorizing them as large or mid or small. And this is the final point, is the reason why it is so is because in India, the ranking, the way companies are classified, large, mid, and small, are basically based on the ranking, not just on the market cap as well. So hope that provides a perspective, Niranjan.
Right, absolutely. And in India, we have a unique way to define what is large, mid, and small. In fact, I was talking to index provider, one of the largest index provider globally, and they actually consider the top 750 stock in US as large cap, and that has evolved. Like he was talking that maybe 20 years or 3 decades back, only top 200 stocks were large cap in US, but today almost 750 stocks in the US universe are large cap, because the definition are based on the size and not the rank. So India has a unique system, I would say. And why not? So if you look at the data, I have some data in which we have given in our insights. If you go back to 2008, the average size of a large cap company was around 25,000 crore. And today, if you see, average size of a mid-cap company is 43,000 crore, which is twice of that what was large cap in 2008. So by size, if you go, probably the number of stocks that we have of large cap in nature are I mean, the list is too long. So you are bang on, Trideep. We should not define it that way. And you can't call all companies small in terms of their size or businesses, because by design, these companies may remain there, but they still are in itself a large business. In most cases, as you alluded to, they are industry leaders. So very well, taken that point that you mentioned. The second thing now is, uh, on the valuation front, Trideep, and I know you are smiling. How are these companies valued today, and historically, what has been the perspective on their valuations versus large cap, mid cap? Unfortunately, I'm going back to large cap versus mid cap, but how are they valued today, and historically, how has been the valuation when we compare between large and mid and small?
So thanks, Niranjan, for that question. It's very topical. I would say before I answer this this question, I must admit that the way we go about stock picking at Edelweiss is that we are a lot more bottom up than market cap categorization wise. So we go out where where the individual merits of the company from an investment case standpoint looks good, rather than what cap it belongs to. With that starting point, a good barometer to sort of evaluate where valuations are today is to put them in the context of 10-year average. And I would sort of, if I were to do that, then I would say that in the case of large caps, they were broadly at par with 10-year average. I think after the recent correction that we have seen, or a bit of a wobble that we have seen, it's about at 5% discount to 10-year average. The mid and the small caps are basically at 20 to 30% premium versus 10-year average. But that is only one part of the story. The other part of the story that we also need to think about from an investing standpoint is that the earnings growth of these three segments are also materially different. Now, as in an answer to the first question, I alluded that when economic conditions are good, what we find is that the mid and small cap earnings growth rates tends to do better than that of large cap. And at the moment, hence, if you look at growth rates of mid and small caps, they are meaningfully better than that of the large caps. And hence, this higher growth has to be balanced in the context of the valuation premium that they are trading at, and then taken a call on from an investing standpoint. The way we are skinning the cat amongst our mid and small cap portfolios here is basically, as I said, rather than focusing on which cap it belongs to focus on areas where we think earnings are likely to be resilient. By doing so, what we avoid are those pockets of irrational exuberance which we do see happening between mid and small caps. Now, that is not to say that one shouldn't go about investing in mid and small caps, but we do see some pockets of irrational exuberance brewing up in certain segments of the smaller capitalization names.
Right. And, I just wanted to talk about one data which we had put out recently. While we have picked and choose, last 2 years for this analysis, last 2 years, if you see the trailing P, and this was before this fall in the mid and small cap segment, the P of at the index level of Nifty 150 was around 26. So last 2 years, it has remained 26. Of course, it went up and then came down, and it has moved in cycles. But last 2 years, it has remained around 26. But at the same time, EPS has grown by almost 67, 68%. And returns, if you see last 2 years, are in line with the EPS growth. Same goes true for small caps. The earnings growth has been around 50, 55%, where the returns in the index has been around 68%. Also, some other data which we were looking at is showing in some segments, in some sectors, the small and mid caps counterparts to their large caps have grown faster, which you already alluded to, because at the beginning, when you said if economy is doing well, usually small and mid caps as a business, they do well because they are more levered to the economic growth. So if you see last 2 years, earnings have grown at a decent pace, while PES is on a higher basis or a higher level, but earnings have also grown. How do you think that earnings growth will shape up in small and mid cap segment? I know you can't talk about segment as a whole, but let me put it in another way. Which pockets within mid and small do you see that it is still attractive at these levels of valuation? And which segment do you see there is exuberance which may not match with the earnings growth that we may see?
Yeah, so I think this is a slightly tricky question to answer, because what's happening is within different sectors there are pockets which are high, which are low on the liquidity front, and there could be some element of irrational exuberance kicking in. So within the sector, stock picking becomes extremely relevant. For instance, in railways, like in some of the stocks which have rallied, been kind of multi-baggers over the last few months. Obviously, there's some of the more illiquid names which have moved significantly higher. Would be one such area where I could point that there are some areas of irrational exuberance that are there or thereabout. But it's a moving feast. This segment changes quite rapidly. For instance, in the correction that we just saw over the couple of weeks, while it overall market-wide correction may not has not been more than 10%, but some of these segments have seen corrections north of 30% as well. So the moot point is that it keeps changing from time to time. Now, the framework that we use to kind of find out where things could be higher is where valuations are meaningfully higher than the last 10-year average, and things could be difficult to analyze from that standpoint. Now, the way we are skinning the cat in the context of diving through the markets at current levels is, rather than kind of going on, as I said earlier, on large, mid or small, finding those areas where we think earnings are likely to be resilient. And those are the areas that I would point you to, where we think that overall there is still value. And of course, I'm pointing you to the areas. Within that, of course, there is need for stock picking, or at least in those areas, in those pin codes, you could find good pockets of value. So I would talk about 5 such areas overall. First, I would talk about Capex as a theme, where over time we have migrated, actually within the context of Capex, from government Capex to private Capex, but overall infrastructure, capital goods, construction, this is one area that we clearly see as one area where earnings are likely to be resilient, and we do see quite a few stocks in mid and small caps that portend to this theme. The second area that I would point you to is real estate. We think that we are in the middle of a 5 to 7 year upcycle, and hence in that context, a lot of companies which are not only just the builders but also the ancillary sectors in this segment appear to be to us as areas where earnings are likely to be resilient. The third area that I would point to is defense. We think that it is a 10-year theme overall, and again, while some companies we could see valuations are on the higher side, but we can still find companies where overall I would say that the valuation and growth conundrum is kind of adequately priced for us to take a position in that. And finally, I would point towards IT services, where we think that earnings are gradually in the process of bottoming out in the course of the year, and we are calling it a dark horse of the year, where over a period of time, not immediately, over a period of time, we will see, period of this year, earnings bottom out, and then next year, as growth picks up, I think you will see the sector doing well as well. So those are the areas where relatively we find earnings might actually be relatively resilient in various shades, and based on our comfort, we are taking exposure overall. And in the context of valuations, I would say if you look at our mid and small cap portfolios, what we are paying for versus what the growth that we get, the PEG ratio of the portfolio is somewhere between 1.1 to 1.2, which means that we are still able to find stocks that are relevant, that are value, and yet not significantly overpay. So that's where I would stop, Niranjan.
Sure. Thanks, Trideep. I just want to pick 2 sectors that you just mentioned. One is, Capex, and the other is real estate. So in Capex, is this, there are companies in the large cap space also, there are companies in the mid cap space also. What I hear and what I've seen is, if you want to play this theme, more players are in the mid and small. Is it right? And within Capex, what kind of exact businesses are in the mid and small? Of course, we can't name the stocks, but which kind of businesses are you? Because Capex is a very wide and large theme.
Absolutely, you are spot on. And I think the couple of examples that I gave qualitatively of businesses which play on to Capex as a theme, for example, the genset maker that we talked about clearly falls in the mid-cap domain. We talked about overall the turbine manufacturer, which falls in the small cap domain. And likewise, there are many plays which are construction guys who play in the small cap to mid cap domain. So all in all, including, I mean, if you look at power, for instance, some of the companies, which is a subcomponent of Capex overall, you would see that some of the players there are quite exposed to the mid and small cap domain. And those are the areas where a lot of investments are going through over the next 3 to 5 years. And we think that meaningful amount of earnings resilience will actually come through. So Capex, as you said, is a broad theme. Within that, there are enough number of companies because they have been operating in niche segments. For example, transformers is a classic example that I would talk to. The largest transformer manufacturer in India is a small cap. So, the largest CNC manufacturer in India is still a small cap. So I could go on, and this could be a 1.5 hour sort of conversation. But net, lot of companies, we are not running short of companies or options in the mid and small cap domain. What we have to balance, as I said, is the valuation versus growth conundrum, which so far we've been able to do and hope to do it in the future as well.
I can't leave this discussion without asking your view on PSU stocks in this segment.
I couldn't catch
PSU stocks, PSU segment,
okay,
in the mid and small.
So I think, we have always, over the last 2 years, taken a more stock-specific view than a PSU view. Now, let me give you an example what I mean. Now, there are segments, for example, within banks, where they are monolithic in nature. It's size-based. But there are other areas like, for instance, defense, where, while in the banking system, while private banks have been taking market share away from public sector banks overall over the last 10 years, in the context of defense manufacturers, the PSUs are far better positioned because capability wise, they are the guys who invested in themselves to create capacity, to create ability to deliver some of the ambitions that India has today of indigenizing the defense sector. So here are two sectors where one is a monolith, the other is kind of, the PSU is actually better positioned as compared to that of private sectors. Likewise, there are multiple other sectors where some of the PSUs are, for example, if you look at the power financiers, the only guys who actually finance the power guy are mostly kind of the public sector companies. So from that perspective, in some of the areas, we find that PSUs do have a role to play in the portfolios, and we have taken a positive view on them. But that is not because they are PSUs, but more so because the segment that they operate, they have a right to win, and their right to win is pretty strong.
Absolutely. So what I take away from this is you can't paint all PSUs with the same color, is it?
Correct.
Right. Moving on, to the the most buzzing thing in the mid and small segment today is liquidity. So how important, rather I want to, ask you a basic question. How important is portfolio liquidity in mid and small cap portfolio? And, what is that comfort zone? Because the liquidity that we have put up as an industry for most of these stocks or portfolios is in terms of days. So what is that comfort zone for you as a fund manager of a mid and small cap fund in terms of days? And lastly, what are the benefits of having a better liquidity?
So I will answer this portfolio from a practicing fund manager standpoint.
Right.
And I think basically a lot of what we call liquidity comfort comes from portfolio construction. If we construct the portfolios in such a way that overall, if we on a rainy day, when times are tough, if things haven't really panned out what we thought out, I can exit the stock without creating too much of impact cost. that is what is called that is the safe operating point in the context of in the context of where we are operating. So at stock picking stage, when we decide as an investment team, when we think about stock picking, we make sure that we build in a bit of a liquidity premium so that we don't get stuck into the illiquid counters, and particularly when times are tough. These are what I would call as Abhimanyu stocks, where getting in is easy, but getting out can be, a bit of a nightmare. So in that context, liquidity is very important, and you can see that particularly when things don't go as per plan, which sometimes once in a while does happen in equity markets. But the liquidity, and hence from an investor from a advisor standpoint, distributor standpoint, liquidity of the funds should be considered as one of the factors when they are evaluating different funds. For example, I know the data that you put out, but broadly speaking, the way I draw comfort is 90% of the portfolio of the midcap fund that we can liquidate in the course of a week. That is basically, that makes me sleep well. What I would also say though, that liquidity is not the only driving criteria. Ultimately, how you manage the performance, keeping liquidity in mind, is basically the way to go about it. What I mean is, by owning illiquid stocks, if you kind of influence the performance in whichever way you do, then over time, that wears off pretty quickly when times are tough. But if you hold the most liquid names, then sometimes performance could become very difficult to manage because it's kind of quite volatile. So and hence I said my opening comment is that the way to manage performance and liquidity in the same bucket is basically what the crux of portfolio construction is all about. So far, we've been able to manage the same at our end at Edelweiss. Hopefully, we can continue further. You can see, just to quote some data, that and by the way, we monitor this pretty closely on a monthly basis. Our mid-cap portfolio can be liquidated 50% as SEBI disclosed in the course of 2 days, and 25% in 1 day. Very comforting to note. But equally at the same time, one of the rating agencies, which is Morningstar, rated our mid-cap fund fairly highly as the Gold Star rated and whatnot. So we've been able to manage the performance and the liquidity both simultaneously, which is something that we are, proud of.
Right. Great, Trideep. Now, coming from an investor's point of view, as I said, and we looked at the data over the last 3 years, mid and small cap index is around 30% CAGR. Funds are much higher or around that. What someone should expect from this segment over the next 3 to 5 years? I'm not asking for that CAGR number, but should they tone down their expectation, or do you think that mid and small cap would continue to outperform because we are in an upcycle? So what one should expect over the next 3 to 5 years from mid and small cap?
So I would answer this question in this way, that I think at the moment India is going through what I would call as the earnings resilience moment. And India is going through the earnings resilience moment without the global support. Global, actually, economic conditions in the way they are actually a bit of a headwind. And in those circumstances, we are seeing broad-based earnings resilience that have come about. And hence, I would say that mid and small cap earnings would have earnings support over the next 2 to 3 years, assuming, of course, stable macro and stable government, which we are right in the middle of. On top of that, if over the next 2 to 3 years we do get some global support, then another part of India Inc., the listed India universe, could also get a bit of a fillip, whose earnings at the moment are probably sulking, given that they are more exposed to global earnings, and they could stand to do well. So far, from where we can see, if you look at our mid-cap portfolio or our small-cap portfolio, we can still construct a portfolio with a PEG ratio of 1 to 1.2. That makes me feel that overall, the return that one could expect could be slightly, maybe 5% lower than the earnings growth that the companies can exhibit. And hence, I would say that given that we put together a portfolio of stocks where earnings growth are materially higher than that of the benchmark, we hopefully should be able to do better over a period of time, maybe slightly short of the earnings growth. The point I'm highlighting is that it is not one size fits all. It's basically the portfolio of companies and the growth that that portfolio exhibits, the return would be commensurate to that. So hence, I am fairly kind of, from a 5 to 10 year perspective, if you were to ask me, I think being selective in mid and small caps is the right way to go about it, rather than completely ignore the segment. And that's what I would kind of think about from investing in those spaces. But the earnings outlook needs to be about 5 to 10 years, and and if the earnings outlook is near term, then maybe one could moderate the return expectations given the huge return that we have seen in the past, but that is transient in nature.
Right. Just extending this question. So what different investors should do and expect? One is investors who's already invested in mid and small cap. What should he be doing?
So I would say that not just for mid and small cap investors, but if you ask me today, amongst the entire roster of funds that we are recommending, I would say that overall, ultimately, in the given where valuations are, where large caps are at fair valuations, mid and small caps are 20 to 30% higher than 10-year average valuations, having a balanced portfolio is the way to go about it. So for investors with reasonable risk appetite, we would recommend our multi-cap portfolio amongst the bouquet of offerings that we have. For a more conservative investor, we would probably meander towards the flexi-cap fund, which is more large cap oriented. And for aggressive investors who have investor horizon of 5 to 10 years, for them and who have a stomach for digesting the volatility and near-term drawdowns, we would recommend our mid-cap fund. So if you look at as a manufacturer, of course, we try to do best in each category, and our funds are top 2 quartiles. That's what we plan to deliver or as much as we can over a period of time consistently. But if you ask me to choose within the entire basket, those are the 3 areas that we would like to be. The only, as you said, that for different sets of investors, what would the advice be? I would say that at the moment, given where we are in markets, probably investing in tranches is a good way to go about it rather than lump sum.
Okay, so that you answered my second question, which is one who's looking to invest in mid and small. You recommend going through STP and SIP at this point in time. And of course, with that, the view is even clearer for investors who are running their SIPs. I think so there's no point in stopping and trying to time the market. You should just keep them running, is what we can recommend. Absolutely, Trideep. Great interacting and getting insights on these questions. We have a couple of questions from our distributors, and I'll just go one by one.
Sure.
So one question is around risk. So risk is usually more in small cap companies. So what should be the investment horizon if someone is investing now? Generally, people look at 3 to 5 years, but now since overall valuations are on a higher side, is that the right time horizon, or should that be increased?
So I would recommend that for particularly for investors who are with aggressive risk appetite, who are moving towards mid and small caps, should have a horizon of 5 to 10 years. We think that over that time frame, the earnings growth shines out meaningfully as opposed to just the starting valuations, and the volatility of valuations or the volatility of economic cycles kind of evens itself out. So I would recommend a time frame of 5 to 10 years for investors who are kind of moving on to mid and small cap domain.
The other question is around the PEG ratio, which you mentioned twice, that if you see a stock between 1 to 1.25, it's a comfort zone. The question is around that, what is a good PEG ratio and why?
Yeah. So I think I again don't want to, and thank you for that question. This is not the framework to invest. We actually have, this is an outcome. and this is just a monitoring tool. So we ultimately run detailed models on all the holdings that we have, and we have our estimate of intrinsic value, which drives our investment decision to hold or not to hold a particular stock. As it turns out, as a measure of valuations, the mid and small cap average PEG ratio is hovering somewhere between 1 to 1.2, and hence it gives me the comfort that we can still. So if we are talking about a massively overvalued market, we would have to be dealing with a PEG ratio 1.7. That's what I would call as expensive. If I can get it at 0.7, then it is die hard cheap. So we are somewhere in the middle, and that what gives me the comfort is that we are not outrageously expensive now, and hence I would encourage investors to think about this as an outcome rather than using this as a way of investing. But still, ideally, I would like to go for a PEG ratio of less than 1, if you really ask me. But again, this is no shortcut. Ultimately, one has to understand the detailed earnings drivers of the company, put that with regards to the expectations, and see what the fair value comes about before investing, rather than relying on just one ratio.
Right. The next question is, around the macros and markets, not specific to mid and small cap, is if, a falling rupee versus dollar, how do you see this peg working, and will this impact the FII inflows into India?
So falling rupee versus dollar, basically you are talking about a dollar appreciation environment.
Yes.
Now, there are a couple of things to keep in mind, and I would at the outset claim ignorance, saying that I'm not a currency expert, and I have seen, quite frankly, in my 25 years of experience, very few currency experts. With that caveat out of the way, if you were to say that the currency, the Indian currency, would actually depreciate against US dollar, then all I would say is basically different set of companies would start to do well as compared to others. So on net balance, on a relative basis, one will have to play around with the stock picking to get that right as the beneficiaries, rather than change the circumstances. That's one way from a portfolio construction standpoint. But the question, I think, really was with regards to FII flow. Again, in a dollar strengthening dollar environment, FII inflow or outflow would actually be a bit of a drag, to be honest. But what I would draw your attention to is that ultimately, FIIs go, or investors go, where earnings growth is. And if you look at today Indian earnings growth in India relative to the world, no matter which strategist you think you read, most of the people are saying that from a growth standpoint, there are very few better markets than what we find in India. That's the starting point, first point that I would sort of make in this context. The second thing I would make is that if you look at the inflows in the form of SIPs and in the form of insurance flows, all in all, put together, the domestic inflows tantamount to somewhere around $20 to $25 billion, and that has almost negated the impact of FII inflow / outflow and the impact of the same on markets overall. So as investors, maybe today and going forward, we shouldn't be as worried as on FII inflows as we were earlier. And when I say earlier, I mean about a decade or so ago, because the domestic inflow environment is reasonably strong.
Got it. Thanks, Trideep. One question is, if one were to create a portfolio today between large, mid, small, how much percentage would you keep mid and small?
So I think the correct way to sort of answer this portfolio, it has got to do with the risk profile of the investor that you will enter in. And there are two funds I would kind of bring to forefront to answer this question. Now, let us take our multi-cap fund. This is for an investor with a reasonable risk appetite. And what we have done there is basically our large cap exposure is about 45 to 46%, and our mid and small cap exposure is about 55 odd percent. That's for an investor with a reasonable risk appetite and long-term time horizon. But for investors who have a more conservative outlook, whose return outlook are a little lower, but they don't want as much volatility, I would point you to our flexi cap fund, where our large cap exposure is basically hovering around 70 to 71%, and roughly the mid and small cap exposure is about 30%. So these two are examples for you based on the risk appetite, how one could maneuver the portfolios. But there is no one size fits all. It's got to do with mapping the risk versus the return, and then plotting the portfolio accordingly.
Right. So if the other way to read this, Trideep, is, and correct me if I'm wrong, is in both your flexi cap fund and multi cap fund, you're kind of neutral on mid and small cap exposure, because if we compare that to a benchmark in say flexi cap, the Nifty 500 is the ideal benchmark, and 70% of Nifty 500 is largely mid cap, largely large cap, sorry. And in a multi cap fund, the multi-cap benchmark is 50, 25, and 25. So over there also largely you are in line with what the benchmark has in terms of exposure. So in most of your funds where you have flexibility, currently I would say, are you neutral on mid and small cap exposure in terms of percentage?
Yeah, so I would be slightly overweight large caps and neutral mid and
Okay.
small caps when I have the opportunity.
Okay, got that. Thank you so much, Trideep. I think so we have covered most of the questions that we could in the given time. I just want you to explain very briefly and reiterate a process which is fair philosophy briefly, and then maybe any closing comments.
Sure. So I think at the end, valuations will come and go. Good times of earnings will come and go. But what I want our distributors and the listeners to this call to think about after we put down the phone and we kind of go on to celebrate Holi is that the way we go about investing. And the way we go about investing revolves around 4 key principles. And those 4 key principles are forensics, acceptable price, investment style agnostic, and robustness. We call it the fair investment framework. And while these may appear as disjoint English words, if I were to put together a thread through all of this, the way I would say this is, we at Edelweiss MF are bottom-up stock pickers. We are interested in financially clean companies, which comes out of a forensics analysis. We are investment style agnostic. We have basically, while we have value stocks, we also have growth stocks in our portfolio. We think these two are joined at the hip. And at the end of the day, there should be components of value and growth in every stock that we own. We are interested in robust business models, i.e. companies that have return ratios more than cost of capital over the last business cycle. And finally, with all of these characteristics together, they should be available to us with a decent enough margin of safety. And the margin of safety that we look out for is 20% or more. So on net balance, whichever stocks that we find has these characteristics going for them, you would find them in our portfolios across 125 to 130 known names that we hold across different portfolios of the portfolios that we run. While this is what we do, I think a minute on what we don't do is also important to know. I think there are 3 things that we consistently and carefully and mindfully avoid doing. First of all, we don't take cash calls. You'll find our portfolios at any point in time close to fully invested. The second thing that we don't do is we don't take macro calls. We do take sectoral calls, but we don't take macro calls like interest rates, currency, and things like these, because we think that ultimately we want to have an idiosyncratic portfolio where the bottom-up hypothesis kind of comes to the forefront rather than some macro exposure. And finally, we don't overly expose ourselves to a single sector, which means the sectoral weightages are within 5% bracket of the index weightage overall. I think broadly, if you ask me, a bit on what we do and what we don't do, these are the guardrails that we have set for ourselves within which we operate, and hopefully can deliver consistent numbers over a period of time from a competitive standpoint. With this, I would wish everyone a very happy and prosperous Holi. Hopefully, your life, like the festival of Holi, turns out to be colorful and hopefully, through our mutual funds, we can participate in your portfolios, making it more colorful with positive returns over a period of time. Thank you very much and happy investing.
Thank you, Trideep, and thank you everyone for joining in today, and wish you again a great time with your family and a happy Holi. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.